as our leader, in charge of the multifamily, but he has such a great story, built a company, Akara, and then now also trying to show people why OZs and how does it plug into all this. But Todd, if you don't mind sharing, your really illustrious career, since you had a very long, illustrious career, and we really thank you for leading our multifamily ground-up construction and really going into Akara and OZ. But please share your story, Todd.
Well, Jim, thank you. I'm excited and honored to be a part of this. As you know, I've been a huge fan of yours for years. We've known each other for a very long time. Like you said, we go back to the Marcus Millichap days. So we've fought in the trenches together, right? And I came to I'm originally a Midwest guy. I came to California in the early 2000s with a tech company. And when the dot-com bubble burst and everybody went back to the East Coast or the Midwest, I stuck it out. I got into commercial brokerage. I worked for a boutique leasing firm in downtown San Francisco and met my wife, who's from Southern California. And I ended up working at Marcus Millichap in Southern California. And that was kind of the beginning of my commercial real estate career. I did multifamily at Marcus Millichap. We moved back up to Northern California after about 5 years of living in Long Beach, and I went to work for CB Richard Ellis. And this was right around the time of the financial crisis, right? So that was reinvent your career number one. And going into the financial crisis when transactional velocity for existing multifamily dropped off, and Jim, at the time, I was doing larger kind of pseudo institutional type apartment brokerage, but that business shifted quickly during the financial crisis. So we created a model where we moved up the food chain and we started selling dirt to builders who were building apartment buildings, primarily production builders, merchant builders. And we built a vertically integrated model, which at the time I didn't realize was more of a cycle-proof model. Instead of just selling existing properties, we were selling raw unentitled land to groups who were entitling it. They would then sell it to groups who would merchant build it. And we stayed in the continuum to sell that product when it was finished. So we took that platform and we scaled it nationally. At the time, my team was acquired by Cushman Wakefield. And I spent 5 years at Cushman Wakefield running their multi-housing team for Northern California and helped them expand their national land practice group. So we were selling dirt to people building apartment buildings, and we realized very quickly that there was an opportunity to integrate the capital markets platform at Cushman Wakefield and provide that construction financing, which led us into the equity business. The missing piece of every real estate deal, as you know, is the equity. So fast forward to today, we started our own company, Akara, about 5 years ago. As you know, my partner is a real estate attorney. He's a securities attorney. So we're in the business of sourcing equity directly. A lot of family offices, sovereign wealth, high net worth investors. We do construction debt. We've stayed primarily in the multifamily business, but we deviate a little bit. We'll do master plans where there's hospitality or retail, but I try to stay within the multifamily world. But today we've expanded nationally, and we have expanded vertically. So we do brokerage, we do debt, we do equity, we do development, and we do existing. And because of the regulations around opportunity zones, 90% of those deals are ground up construction. And as you know, there's not really a specialty practice group in commercial real estate nationally that does ground up development. They're land brokers, which is actually a very different business. We help multifamily developers do everything from site acquisition to financing to equity. And that just dovetailed perfectly into opportunity zones. So we have a team, a specialty practice group that does opportunity zone business nationally, which has led to us starting 3 or 4 different businesses oriented towards the opportunity zone space. We're raising capital. We've got a platform called OZ Listings, which is a national marketplace where LPs and GPs can find opportunity zone projects.
Can you share with the audience and everyone else, they may not understand, opportunity zones and how they came to existence and why it was so important as a fit. If you don't mind kind of just sharing in a way your definition or what you know for everyone else in the audience about opportunity zones.
Yeah, good question, Jim. There's a lot of confusion around opportunity zones. Anytime you throw in hundreds of pages of tax code, real estate guys tend to shy away from that complexity, right? But really what it is at the end of the day, different political administrations have different ideas on how to create housing. Everyone knows that affordable housing is one of the biggest issues in our country right now. And the previous administration, their policy was to subsidize the creation of affordable housing, right? There was tax revenue that created buckets of money that were used to subsidize affordable housing, and a lot of nonprofits built that housing. And that business is still alive and well, but you really can't subsidize your way out of a housing crisis. So the current administration, in Donald Trump's first term, Senator Tim Scott from South Carolina, he drafted the legislation to create opportunity zones, which is really an incentive for private capital placement into the development of housing and jobs in underserved communities, which they created a map based on the census tract data of 2010. All of this, as you know, is being updated right now. But I believe that it is going to be one of the biggest solutions our country has to create affordable housing. It's an entirely different category of investment capital that operates almost counter-cyclical to what we're seeing with institutional equity coming into housing. I don't want to say it's cycle proof, but the fact that cap gain investors are incentivized in such a big way to invest in these opportunity zones, we're going to power through market cycles in creating housing. And we're on a mission to help solve this country's housing crisis by facilitating the free flow of direct investment capital into the creation of housing in opportunity zones.
Todd, can you share kind of an example? Because I know you're working with so much raising capital, putting capital, now running the whole part from cradle to grave. Can you share a case study with how, let's say, a development deal in multifamily succeeded and facilitated, a successful project from site, to exit and raising the capital and getting the benefits, especially I think, who are the investors, right? And like you said, I think that's the biggest thing. The money piece, the equity piece, the bridge piece is always the hard part. But what is the incentive to get them in to invest? And I think, right, unless they change the laws, right, it was that 10-year benefit or washing some of your equity that you may have got from whether it's the stock market, or we know a lot of the investors that got stock options, right, that made a lot of money that wanted to help kind of wash that.
Yeah, no, I mean, good questions, Jim. And really, to break it down in very simple terms, real estate investment is about two very basic things. You got to find the deal and you got to find the money, right? And 99% of the service industry is focused on one or the other. Brokers find deals. Where the money comes from is a completely different business, right? That's the capital markets. But there's a lot of uncertainty, a lot of mystery around where the direct investment capital comes from. If you go to a traditional capital markets platform like Walker Dunlop or CBRE or eStill, and you want to build a capital stack using debt and equity, you're going to get a lot of resources for debt. But on the equity side, primarily what you're going to be introduced to is an institutional conduit like Blackstone, right? There's not really a platform out there that gives you access to the direct investment capital. We've created that marketplace in the opportunity zone space. We bring the deals to the marketplace. We're attracting investors to the marketplace. But real estate guys are always looking for money. Money guys are always looking for real estate. We're helping them find each other. And there are several different examples of projects we're working on, and I'll give you one. We're working with a developer in Dallas, Texas. They own a significant portion of downtown Dallas near the farmers market. It's an incredible emerging submarket. It's in an opportunity zone. It's a great sponsor. They've conceptualized an incredible project. There's layers of tax incentive on this that make it a highly feasible deal. But like a lot of developers, they're struggling to figure out where to source that capital. So on the capital raise side, we go out to a broad audience. We're very deep in the family office space. And the family office space is an emerging cottage industry that a lot of people are unaware of how it works. And it's because there's a saying, if you know one family office, you know one family office. They all kind of do it different. And there's over twice as many family offices as there was pre-COVID. So we're sourcing that direct investment capital. And the incentive on behalf of the investor is a lot of these high net worth investors, family offices, we have a crypto desk, right? If anyone has had a significant capital gain, In real estate, as you know, if you sell a piece of property, your tax mitigation strategy is a 1031 exchange. If you sell a company or crypto, or you've had some other large capital gain, you don't really have the option to do a 1031. Opportunity zones are an incredible tax mitigation strategy. And to answer the second part of your question, Jim, the benefits you get in very basic terms from opportunity zones is the first thing that happens is you get a deferral. Now, we're in the process of passing this updated legislation back and forth between the House and the Senate as part of Trump's big, beautiful tax bill. And we're very optimistic that we're going to get either a reset or an extension of the opportunity zone benefits. They may even increase. But the first benefit alone is you're deferring your capital gains tax payment. That's significant. You get to use your own money for at least another year. It could be 2 or 3, and there's talk about it being a rolling 7. The second benefit you get is when you invest that capital gain into an opportunity zone, into a qualified opportunity zone fund that goes into a qualified opportunity zone business, that project grows in value tax-free. The other important piece of that is you are not recapturing depreciation. So you have to hold it for 10 years to get the benefit of that tax-free appreciation. But if you hold it through its full depreciation, you effectively have a fully stepped up basis and you've got no capital gains tax exposure on that exit. So it's called, and it's referred to by a lot of people as the greatest tax break in American history. But what I love about it is it's serving a very important purpose of creating jobs and housing. So everybody wins in this opportunity zone structure. And I think we're, after years of everyone trying to figure it out, the service industry trying to figure out how they can participate, it's all kind of come together, and we're about ready to see opportunity zones really blow up in the next, I think, 10 years.
Wow. I'm really excited with this because a lot of people don't want to pay taxes, want to defer it or wash it possible. And I know I shared Akara and OZ listings to share with everyone as you're building the funnel for anyone that may have an opportunity to reach out to you. And this is the hardest thing because I know I talk to people, everyone hears OZs, from the last administration when it was first set up. How do you find what's in an OZ area? Because I know no one really understands how to figure out if their property is actually kind of an OZ candidate.
Well, it's interesting because they try to make it fairly simple and accessible. There's a map. There are several opportunity zone maps online. One of my partners has just created a map based on new census tract data, which is, the crystal ball map of opportunity zones. We factored in a lot of updated information, demographics, and there's some new language in the opportunity zone draft legislation around the benefits for rural markets. So we've updated our map, and although it's not perfect, we think it really gives people an idea of where opportunity zones are going to be. Some of the map area is going to be phased out because the areas have been improved, but really what we're trying to do is just expand this, right? There's no bad place or no bad time to add jobs and housing, right? So if we happen to put something in an area that's nicer, that's okay, because you and I both know that what solves the affordability crisis is just adding supply. So
Todd, should they reach out to you, or is there a website that they can go just so they have an idea? Because I know people have opportunities. They think it's in the path or in the process possibly of being OZ. Is there a website that you kind of use? I know you may have your own proprietary, cost money, putting the data, building it, updating, as we all know, not old stuff. So is there kind of an easy or government website that people can go to?
there are several, but we have a website, ozlistings.com, which has a copy of the map on there. We are soon going to release on OZ Listings that updated map with our projections of where the opportunity zone map is going to be. One of my partners in OZ Listings, and I brought together a lot of leaders in the industry. We've got attorneys, we've got a large tax advisory firm with tax attorneys on there. So we can effectively do everything for the developer. If you have a piece of land that you want to develop, it's in an opportunity zone, or you discover it's in an opportunity zone, we can help you form a QOZB. We can help you form a QOZF. We can help you manage that fund for full compliance. We can help you do everything so that you as a real estate developer can do what you do best. We can build the capital stack with debt and equity. On the investor side, if you've had a large cap gain, or a cap gain of any size, we can walk you through the process. We can help you form a captive QOZF. We can help you find a number of opportunity zone funds that fit your criteria for investment. We qualify them, we vet them. A lot of those projects we're providing debt for. So we have in-depth underwriting and feasibility analysis on all of these projects. We can help you form that fund. We can help you manage that fund. We can help you deploy that fund. And we've got an expansive team that does this for clients. And it's kind of an a la carte menu. We provide the service that you need, but we can do it all if that's what you need. I have a partner at ozlistings.com, Jimmy Atkinson. A lot of people are familiar with Jimmy in the Opportunity Zone space. He has the Opportunity Zones podcast. He owns opportunityzones.com. He's my partner in OZ Listings. His website, opportunityzones.com, is an incredible resource. If you're curious about the opportunity zone business, or you have a capital gain, or you have a project, you should visit opportunityzones.com. It's an incredible resource for educational information. There's a robust community there. I'm part of a group he formed called OZ Insiders, and there's a master class every month where you can go and just learn everything about it that you've ever wanted to know, or you don't have to know anything. You just have to know someone who does, and there are people there that can help.
Well, Todd, now everyone's met you, so they can use you and kind of go through. And I added two of your websites with Akara and OZ Listings. We got a technical question from David Monroe. Hello, David. He said, can the relaunch of bonus depreciation, if approved, also be used in conjunction with an OZ strategy?
Absolutely. You're not recapturing depreciation in opportunity zones. So any manner in which you depreciate through bonus or accelerated depreciation, through cost segregation, are all applicable in the opportunity zones, in the opportunity zone world.
Thank you. And see, that's why I think you should work with experts in the field, because there's so many ways. Like you just brought up cost seg. We're going to have somebody talk about cost seg, when cost seg, applying it with OZs, right? With everything else. I mean, can you share, how many benefits a project can be by just using OZ and maybe other like cost seg and other tax incentive structures that the government gives you? What's kind of the biggest and best deal, highly levered and just a huge success, using OZ strategy?
Well, I think the first thing that it's important to note, and when OZs first came out as part of the Jobs Act of 2017, people thought it took a bad piece of real estate and made it good, or a bad deal and made it good. But that is not the case at all. You have to start with a good, feasible deal day one. And an opportunity zone structure can make a good deal great, but it will never make a bad deal good. So the first thing we always do when we're looking at an opportunity zone project is we incorporate our debt platform. We underwrite it from a lending standpoint, which, as you know, is really the math that people use for qualifying a real estate deal. I, as a real estate guy, can model a project, but it doesn't really matter until I've incorporated that debt partner. So the debt math is what we use. And really, to define feasibility, it's a simple process. We want to model a project to 100 to 150 basis points yield on cost above the current cap rate environment. So if you can buy a 5 cap apartment building in Berkeley, California, and you want to develop ground up, you really want to build into a 6.5 untrended yield on cost. So this market cycle, as you know, Jim, has done a lot of things to create a slowdown in development and in feasibility. Interest rates alone, if you were building to exit at a 4 cap and now you have to exit at a 5.5 cap, that took about 25 or 30% of the development pipeline across the country and kind of dropped it into that category of no longer being feasible. But if you go out across the United States into secondary, tertiary markets where it's very cost effective to build, where institutions traditionally haven't participated to create an abundant supply response to our demand drivers, there are feasible projects all over this country, feasible housing projects in areas where housing is desperately needed, that are some of the best projects in the country. So,
and see, I love that where we were always saying it's only in certain states, the big builders can build because they can play, they have the infrastructure. We used to know a lot of even spec builders, right, that were playing this game, but now it got too costly, holding costs, just uncertainties. People had to be right on or deeper pockets to play this. But adding the OZ, like you said, and I love that you brought this up. You can't make a bad deal good by
Yeah.
making an OZ. But let me say this, because we all know there's always a cost. Like when the EB5 craze went on, right? There was a massive cost doing that or working with regional centers. What do you see as kind of the low cost, minimum cost to get started? So if you see something, at least, call you if it's in the market, but if you're a feasibility study, what does an OZ kind of back of a napkin or very good enough, right? But not spending too much money. What's the cost? What's the cost of getting this started?
Yeah, good question. So, Jim, when I went from being a multifamily broker to a development broker, I really became an advocate for the developer. I mean, these are the guys across the country who are building our country, who are solving our housing crisis, who are building. And historically, they've had a lack of access to good capital, right? So, as an advocate for the developer, if they're going to do an opportunity zone project, they effectively have to assemble their own team. They have to find an attorney that knows opportunity zones. They have to find a CPA. They have to find a real estate guy. They have to find a capital markets guy. And you really need to put a team together. So what I've done is I've gone out and I've built what I think is one of the greatest opportunity zone teams in the country. And we've got the attorneys, we've got the tax attorneys. We're partnering with Baker Tilly, one of the best real estate oriented tax advisory platforms in the country. And it's a service that we provide that you only pay for what you need. And it is very, very cost effective to bring in an expert who already does this all day, every day, right? A lot of people are paying for their CPA or their accountant to go through this learning process. And where it really costs them is we've seen this done incorrectly a lot of times. So it's not expensive. It's very cost effective to form a QOZB, to form a QOZF. That's just a legal process. And if you hire a lawyer who does it all day, every day, it's a nominal cost. Raising capital and the cost of raising capital, there's a lot of confusion in the marketplace. And if you're a developer and you want equity for your project, first of all, what do? Do you go to East Hill? Do you go to Walker Dunlop? That's where you go to get debt. But if you want to get equity, I mean, they can bring you Blackstone, they can bring you Carlyle, they can bring you Berkshire, they can bring you a couple of pseudo institutional opportunity zone funds, but it's not the most effective, certainly not the most cost effective way to raise equity for a project, especially opportunity zones where you have the benefit of being able to go direct. We see a lot of developers go the course of the managing broker dealer or the RIA route. Top tier developers across the country have kind of built out that vertical part where they raise and manage their own fund, and they do it through the broker dealer network. We have a managing broker dealer. We are FINRA compliant when we're raising capital, but that's actually one of the ways we do it because that's an expensive way to raise capital. What we have done is we've created a platform and a network where we give good projects exposure to, first of all, my database of thousands, tens of thousands of real estate investors across the country. We have a very robust family office network that we market to. We have our crypto desk, as I mentioned. We work with business brokers. So anywhere there could potentially be a source of a large capital gain, we want to educate those people on the opportunity zone structure, and we want to bring them into the marketplace where they can source the deals and the developer can meet the investor. We create that programmatic relationship in a very cost-effective way. And hopefully at the end of the day, we see a lot more product built based on this structure that we've created.
Todd, I definitely am glad we're doing this and catching up in a way. Sometimes I'm learning back from you, what have you been up to? Because we're all so busy. But now with the market booming, especially crypto, with Bitcoin, there's no financial advice or anything. But, just watching this, there are a lot of people that are the crypto billionaires again. And actually, I should reach out because I was involved in that network, possibly asking people instead of paying taxes, because now they're going after, right? Regulating it to tax it, right? And we see some of this on our IRS forms now. But with that, talking to you, how do you find a good piece of land? Because you're right. Just because you call it OZ, and this was a misconception too, we all think it's crap, right? We all think it's bad real estate. But sometimes because of way the government put the map on, some areas are pretty dang good. I'm like, what? How is
Yeah.
that unique? So if you could share,
Well,
that's
and
kind
now
of
it's a great question. And Jim, you mentioned the market's booming, and it depends on who you talk to and where they're at. I'm in Northern California, right? And we're still shut down, right? We have, because it's so expensive to build here, because we've seen a supply surge, because we've seen rents taper off. We're kind of at the eye of the storm. I think we're in the gulch of a market cycle here. A lot of larger kind of institutional darling markets like Austin or Jacksonville or Nashville, where we saw this abundant supply response to the demand drivers during the migration patterns of COVID. And those are boom bust markets, Phoenix. And we all know these markets across the country. You move into secondary, tertiary markets, and you're seeing rent growth in the Midwest and the Northeast because institutions didn't participate in this robust supply response to the demand drivers. And that's why rents are dropping for the next couple of years in Austin, because everybody went there and built an apartment building in the last 5 years. But rents are rising in Kansas City or in Omaha. So it really correlates nicely with opportunity zones. We go out and we look in these secondary, tertiary markets, which are historically underbuilt. And real estate's a local business, right? It's a supply and demand metric at the end of the day. You don't have to overcomplicate it. If you're gonna invest in a market or build in a market, you look at the competitive development pipeline moving forward. You look at the current vacancy rate. You look at the current demand drivers, and it's easy to pick. And there's a lot of resources out there where you can look and find markets that are projecting rent growth. And I think it's going to be years, maybe decades, until institutions start to shift their patterns. The opportunity zone structure really creates this wonderful kind of scenario where direct investors are investing in ground up development. And in my 20 years of real estate, Jim, you and I have seen a lot of money go into syndication structures, right? And there's an abundance of syndicators out there that are a lot of them are very good, but you're not necessarily in control of a market cycle or a sub-market. And if you're just a passive retail investor investing in syndication structures, you're kind of a passenger on that bus, where if you're moving up the food chain and you're owning things at a cost basis, you're holding it long term. This is what I've learned from some of my most successful and wealthy investors, is they're involved in the development part of the business. And when you make good choices, and when you invest in good development deals that are profitable, that are feasible on day one in good submarkets, those are the tools that people use to create generational wealth. And that's part of what we're trying to create, is opening that up to a lot more investors.
And I like that, building funds, OZ funds. What does that look like from maybe equity investment to the project? What's the size? Is there a size that is a sweet spot for all of this that you have to go through? Or can you do it, just a tongue in cheek? Could you do it for a single family house, right? What is the dollar amount that you would say is the right fit to really explore doing an OZ?
Well, for our business model, for our service model, there's kind of a sweet spot, right? And we tend to hover in the top of the mid market, right? Just below the institutional radar. But because there's not a lot of institutions participating in opportunity zones, initially there were some, Cantor Fitzgerald and Bridge and Origin and some really good, kind of family office structures were investing in opportunity zones, and they still are. But what we're seeing is an opportunity for, mid-market investors. If you've had a $2 or $3 or $500,000 capital gain, or if you've had a $75 million capital gain, there's a structure that we create, a bespoke structure for you to make the best investment based on your criteria, right? So we are, again, seeing some of the best deals, some of the most feasible deals in some of these secondary, tertiary markets that are great markets. They're just historically underserved from the production side.
And I'm actually talking to clients in certain markets, so I definitely want to reach out kind of in the secondary, tertiary, as you were talking about, some of them in the path of progress. How would you go about, let's say, identifying, besides the map, would you, as let's say, a criteria list that you have to start going through it? And I love that you use it, and I tell everyone as a cheat code to run debt buy any real estate project, the worse the leverage, the debt, the DCR, everything else, that's not a great deal. If they're saying, oh my gosh, this is great cash flow, great area,
Yeah.
right? There's
Yeah.
better. So how would you, through your checklist, help people out, kind of figuring, is it good, is it bad, or just what to look for?
Well, Jim, I took a ULI class. I think it was a 2-day class on defining feasibility and modeling to a residual land value, right? And after 2 days, I was a little bit more confused than when I started that class. And I was in a meeting with a developer a few months after that, and he said something to me that I'll never forget. He said, "Oh, feasibility is easy. It just has to be worth more finish than it costs to build and bake in a little bit of developer profit." So that's how you look at projects. It's what is it worth finished, right? Take a snapshot of the value of that project if we're built and existing and stabilized today, and then subtract what it costs to build. There's a lot of subjectivity to both of those sides of the equation. One of the things we do to kind of mitigate that risk is, as you mentioned, we bring in a construction lender, and I work with some of the biggest construction lenders in the country. We will bring them in. We'll have them use all of the data that they have to create a valuation of that project finished. They'll model it, they'll underwrite it, they'll go out to the open market for debt. We'll get term sheets from lenders, so we know that that's the math that we're going to use moving forward. And we use that same underwriting to go out and raise the equity for those projects. And again, we're looking for a yield on cost that's 100 to 150 basis points above the current cap rate environment. And loosely, what that translates to is if you're going to build an apartment building, you're going to build into a 20 to 25% profit, right? So if it costs you $100 million to build it all in, hard cost, soft cost, last land, cost of capital, it should be worth $120 million all done. So you've got that layer of profit that you're building into. We then stabilize the project. We crystallize those deals with permanent loan proceeds for takeout. And then the group that originally invested in the ground up development ends up holding those projects and opportunity zones for 10 years to get the full benefit of the tax mitigation structure.
Todd, I just love it how you just put it all together. Simple math, simple instructions, right? For people to understand. It's just, a lot of times people don't know the spread, the margins, right? To get the real numbers. So this really quick education was to educate people about what to look for, and when they look at, oh, we're getting a 10%, 15%, no, 20, right? Or better, you're giving people a way to figure out, to analyze it, right? Really quickly. Or at least if the sponsors or everyone is taking too much money, right, out of it, that's not fair to everyone else. So I love that you're sharing this.
That's a good point, Jim. When we put these deals together, we're an advocate for the investor. I believe the benefit of an opportunity zone investment belongs to the investor. It's not there to make a bad project good or to pay a development sponsor too much. When you go direct, and a direct investor goes into a real estate project with a sponsor, those are very efficient deals. There's such a win-win potential for all of those deals. And one of the ways that we're sourcing deals and really the best way to mitigate risk of ground up development, because there is some nuance to ground up development, right? And there's some risk inherent to that because of the development cycle. I think we're moving into a very favorable development cycle. As you know, the production pipeline for the institutions have completely shut down. We're going to go through a 3 or 4 year down cycle where there's no product being delivered. And it's not because we don't need that product. It's because we've got interest rates that are a little bit higher. The exit caps have gone up, so feasibility has gone down. But the way we first and foremost de-risk any project that we do is we work with the very best developers across the country, right? And there are good developers and bad developers. Inherently, the industry is a little bit confusing because all of these joint venture structures are done a little bit differently. We have a programmatic platform that we create that simplifies it in a way that the developer likes, the investor likes. We're in there in the middle facilitating this process, almost like an institution, almost like Blackstone, but we don't make nearly as much money as Blackstone. We make a tiny margin off the middle when we create these good partnerships between direct investors and really good sponsors. And I can tell you, some of the best sponsors that I've worked with across the country are some of the least visible. You go into these secondary, tertiary markets and they're generational, they're vertically integrated, they're the general contractor. They know every deal in their market, they know every piece of land, they've been building there for decades, and they own their market. So we support those developers with this programmatic source of capital where historically they've either used balance sheet or they've syndicated, or on occasion they've gone to the big institutions, but it's traditionally the merchant builders that have used the institutional equity. So,
I want to open it up and let's just say, now kind of somebody's in, they're building the project, but somebody needs to, pull out equity prior to the 10 years. What happens to that investor if, let's say something happens, life happens, 10 years it's short but long, right? For a lot of people as a whole. What happens if they just need their equity? Or is there no options, no way out? Is there that clause about some type of payout prior to 10 years?
yeah, good question. I mean, every call I get on where we're talking about opportunity zones, there's rabbit holes. You can go down rabbit holes and things get technical. And, I want to emphasize that it really is a simple process. It's just real estate at the end of the day. None of this is rocket science, right? But with the OZ nuance, there are some technicalities, and there is a requirement for a long-term commitment and investment. Now, as you know, Jim, you and I have talked a lot about the evolution of technology and real estate and blockchain and creating a secondary market where people have access to liquidity through moving their piece in and out of real estate. But what we're focused on with opportunity zones is you can return 100% of your client's investment basis without incurring any tax exposure. So if you have a $100 million cap gain, or let's just say you have $1 million cap gain, you invested in my piece of real estate, the way we form our structure is it's our goal to get that basis back to the investor as soon as possible. A lot of that equity in a feasible project is returned to the investor at stabilization, that moment where you take out the construction debt, you bring the permanent financing. If you've built into a profit, your construction debt was 60% loan to cost, your takeout financing is 70% loan to value. If you just do that math, a good portion of the equity is returned, and it's returned to the investor in the form of their basis, right? So that's one of the things we're very focused on, because opportunity zones allow you to do that. Now, through the life cycle of that project, we are optimizing the access to liquidity through capital events, right? So we want to refinance when we can. Now, every deal is a little bit nuanced. Some groups are happy being under levered, but for all intents and purposes, if you have the ability to do a favorable refinance with an apartment building anytime in that life cycle, and you have the ability to return up to your basis and maintain that debt coverage ratio, you're going to want to do that. You're going to want to get that basis back and start working with that money again, or move into another opportunity zone project. Or with loan proceeds, you don't even have to, because loan proceeds are tax free.
You know, Todd, I love this, and I think that's what some people think. They think they're stuck 10 years, their money's just, but also working with the right sponsors, people that have a good track record, obviously finding the right project, you get your money back, right, at that exit. No one wants the higher cost of capital. Once stabilized, let's, depending on market environment, right, refi, pull that out. Either way, you're going to take it. You just may not get as much. So what's the advice, before I open to questions of the audience, would your piece of advice be, because you did, I know, work on this for a very long time from different industries and leadership that you had to kind of finally put this all together, because this wasn't easy to build all these experts, to come as a consulting group, as a whole group to help people?
Well, I don't know if I'm smart enough to offer any advice, but one of the benefits I've had in my career is to work with really smart people. And, I remember I was golfing with a couple of guys one time, and they were both principals. And one of them said to me, "I'm rich. I bought and sold a lot of real estate." That guy, he's wealthy. He bought a lot of real estate and never sold it, right? And the guy said, "The best thing about real estate is I can never sell it when I want to," right? You're forced to go through market cycles, and I think a lot of people on this call would probably recognize that we are moving into a very favorable window for housing investment. There's all these kind of potential outlying events with geopolitics and interest rates and what are we doing with tariffs and all this stuff. But investing in housing in our country right now, because we're so undersupplied, we've shut off the production pipeline. As you know, real estate's an incredible inflation hedge. This is the moment in our career, your investment career, your professional career, where I think the next 3 to 5 years are going to be incredible to invest in housing. So if you've had a capital gain, or even if you haven't, we've seen a lot of family offices, multifamily offices really moving into this alternative category, really embracing real estate at this time. But it's not always easy to find deals, right? We are not selling. Well, we do sell real estate, but we're not selling deals. We're aggregating investor capital into what we think are some of the best investment opportunities with some of the best development sponsors in the country. So I would say, pay very close attention to the next couple of years, because these are the wealth creation years for us in real estate.
No, well said, and I like that because I know with everything going off with interest rates, just all the stuff we've been going through. I would say during COVID, right? Survived to 2025. Now it's like survive maybe 26, 27. We'll see what happens. But it's been a long stint, right?
Yeah.
It's been a while. And you're right, they shut off the pipeline of a lot of development housing projects. And as many people know, interest rates are high. The valuation of most single family or housing is still very high, right? It hasn't come down as much as some people wanted or thought, but it's still very, very high. And you're right, with supply demand, that imbalance is going to create a huge opportunity. And if you can get better returns with OZs, and they are not in bad areas, you just got to look. And I know, Todd, you and your team can find the right ones or identify with anyone that's interested. So I want to open it up to questions. So I know there's a lot of very connected, good players, people out there. Do you have any questions for Todd? You may be working on a project right now that you may just have some questions about, or something that may interest you in the OZ space. Any questions? Nelson.
So, are you structuring like a DST investment? Like, is that, how investors might come into projects?
We work with certain DSTs. I'm pretty focused on the OZ space, and we're not really structuring anything as a DST. There's not really a need to. I mean, DSTs, I think, are primarily created to help people with their up leg in an exchange. And because this is an alternative to the 1031 structure, we're just forming them as traditional, fund-driven joint ventures between the investment fund, the Qualified Opportunity Zone fund that we establish in the business. But yeah.
So if I were a tech investor and I sold my company and made a $10 million capital gain, can I use some of those funds to buy Opportunity Zone structure and defer taxes on that?
Absolutely. Any capital gain you use. And Nelson, another interesting thing, because we touched on 1031s and we talked about opportunity zones. If you've done a 1031, if you sell that property, you have to replace the entire proceeds and the debt amount, right? And so there's a lot of times equity in there that you can't take. If you convert a 1031 into an opportunity zone investment, you only have to reinvest that gain. So depending on where your debt basis is, there's an opportunity for you to take what would traditionally be referred to as boot, and just take that money and only reinvest your gain. So a lot of people get caught in that 1031 cycle where you're constantly trading as a tax mitigation strategy and you're replacing the purchase price and the debt. So opportunity zones, because of how they're structured in the timeline, we can even save a failed 1031. So if you've had a 1031, you've gone past your deadlines, we can take that and reinvest the gain into an opportunity zone for you. So it's a good alternative tax mitigation structure for people in real estate.
Very creative.
Yeah. Thanks for the question.
Any other questions? David Monroe, do you have any other questions? Because I know you're a technical guy too.
Well, if I can get my technology to work here. Trying to get my camera on. So I really just have one, Todd, and great presentation. For the 1031 into an opportunity zone, I'm assuming that especially for like a failed, they pay the tax, but then they bring that money into the opportunity zone with the opportunity to not have to pay tax on the gain itself, washing it effectively because you got to pay that tax in the future anyway at some point, even if it's a 1031. Is that the thought process behind that?
Well, the old mantra in 1031 is swap till you drop, right? Just pay until your heirs get the benefit of a fully stepped up basis, right? But with opportunity zones, it's a little bit different. And think of it, David, if you're familiar with a Roth IRA, right? You're basically investing almost what is effectively post-tax income, right? So if you have a capital gain of $1 million, you still owe that tax on that capital gain, but the first benefit of opportunity zones is you get to defer that. And there's still some uncertainty about how that deferral is going to be renewed. But right now you get to defer that until the end of 2026. When it started in 2017, you effectively had an 8 or 9 year deferral on your taxes. Now it's 1 or 2, but one of the big things they're focused on is extending that. So you get to defer that, and you do pay that tax in 2027 at the end of 2026. But then that investment grows tax-free, just like a Roth IRA would. So
I remember that now. Thank you for clarifying that.
yeah, it's if you stick to the basics of opportunity zone and the basic benefits, it's an incredible structure, right? Where it really starts to get complex is people go down these rabbit holes of what ifs and how do I do this, and there's 100 different scenarios. But again, there are people on our team, the team we built, that are just, first of all, way smarter than me. We've got attorneys, we've got accountants, we've got FINRA compliance, we've got capital markets brokers, we've got the whole team of people that help people through the whole process.
Well, if you need somebody to help with feasibility analysis, I'd love to have a conversation with you in the future.
I would love to talk to you. That's a big piece of the puzzle, making sure the deal checks out, right?
Yeah, if you don't mind putting your contact information so people could also reach out. I did put your website there, but David Monroe, if you don't mind putting your contact so Todd could grab your contact and exchange information. And I'll vouch for David. He's good. So
thanks, David.
Thank you,
I
Jim.
see that CCIM behind your name. That tells me you know what you're doing.
Yeah,
Rich
I appreciate
Enderlin.
that. Thank you, Todd.
Jimmy, thank you. I always love listening to Todd Vitzthum. I mean, he's a smart guy in real estate. Hey, Todd.
Thanks, Rich.
For you. What I'm finding right now currently is we still have these interest rate headwinds. And so market rate deals are still far and few in between. We don't quite have the inventory out there yet. Obviously, whether you voted for him or not, Trump is restructuring the entire world economic order. So there's a lot of chaos in the marketplace right now. My question for you is, are you finding a little more flexibility in deals that are in these opportunity zones?
There's always more flexibility in ground up development, right? Because of the lack of capital that's really flowing into the development space. I mean, what I'm finding in the existing world is there's still a significant bid ask gap, just like you, Rich. I mean, we're looking at deals all day, every day. And, a lot of people just aren't accepting the reality of what I think is now the new normal in interest rates and cap rates. And, we've seen a lot of product built across this country that's coming out of production right now. There's this huge surge of supply coming on this year, and those projects were all built to exit at a 4 cap, and now it's a 5+ cap environment. So there are a lot of people who just aren't meeting the market. They don't want to meet the market. They can't meet the market, right? But in ground up development, it is what I think is some of the best deals in the country are in ground up development, if you're working with the right developers. And these guys are meeting the market. When you create a joint venture structure between an investment fund and a developer, the math is the math. The underwriting is the underwriting. The lender creates that underwriting and the math that we use. So we are seeing a lot more. We're seeing fewer feasible projects because of the interest rate environment. But in the projects that are good and profitable and feasible, we're seeing a meeting of the market between the investors and the sponsors.
And just a quick follow-up question. Are you seeing any kind of influx of affordable housing players in that opportunity zone space?
The affordable housing has always been a cottage industry, right? And it's It's for nonprofit groups building housing using a subsidized capital stack. The traditional capital stack is debt plus equity. The affordable housing capital stack is debt plus various layers of subsidies that come from private, local, state, and federal agencies, right? So there's a whole different nuance to how the affordable housing world works and the restrictions associated with building an affordable housing project and accessing those subsidies. There's a lot of talk in how to bring the benefits of opportunity zones together with the benefits of affordable housing. There's a tax firm out there, Novogradac, that you may be familiar with. That's very proficient in the world of affordable housing and in the world of opportunity zones. And they've been writing a lot of articles about the potential of how these two worlds come together. And I think you're going to see that in the future, but you haven't, it's in looking back, it's been two separate industries that haven't really fully crossed over yet. But moving forward, I think there's going to be a lot of tie-in between affordable housing and opportunity zones.
Awesome. Thanks, Todd.
Yeah. Thanks, Rich.
Any last questions? One last question. Todd, thank you so much. But, this is the thing that you brought up before. Many of us said this in commercial real estate. Transactional is kind of easy, but if you're starting to go into whether it's syndication or others, you do need an expert group around you. And sometimes you don't know what you don't know, that just putting extra eyeballs on. Well, I see Conlon Chang. So let me ask you one final question for me. We're all talking about housing. Does OZs work in commercial and other product types, not just housing and multifamily?
It does. I mean, anytime you're developing real estate, there's a certain framework of compliance, and there's a substantial improvement threshold that's being revisited right now. Right now, if you're going to invest in an opportunity zone, you either build ground up, or you have to match the value of the improvement through capital investment on an existing project. So it works across the board for any asset class that you're meeting that baseline criteria. And I think the future legislation is going to lower that substantial improvement to allow for a lot more adaptive reuse and opportunity zones. But we're seeing hotels, we're seeing retail. There's a surge of self-storage. It works for data centers. Anything that you are meeting that criteria of either round-up development or substantial improvement, that works.
Todd, thank you for being our guest on Top Agent Commercial Wednesdays. This is really knowledgeable. This, with your expertise, just teaching, training, I know you really enjoy giving back and helping everyone understand this. So it does work for everything. And I know Todd knows all the other players in OZs, but he does focus on the multifamily housing, really from cradle to grave, or at least studies. Talk to Todd if you're just curious if it's OZ, and I know you'll know everyone in this space to really help everyone plug in, right? See the fit or not. And I know because of your expertise, you can give them advice. To be honest, anything housing,
At this point, I've been doing this for a long time. My hair is gray. So yeah, I if I don't know, I know someone who knows, and I'm happy to help anytime. We're a resource. Go to our website. And Jim, I really appreciate this. It's always great to see you.
Good seeing you too. Thank you again for being on as a guest. Please reach out to Todd Vitzthum and also Akara OZ listings to just see what's going on, get some more knowledge, because knowledge is power. So everyone have a great day. Looking forward to seeing everyone next Wednesday again. Thank you so much. Have a great day, everyone.
Great
Thanks,
meeting.